Inflation. I'm sure you have heard this term before, especially in the past couple of months, weeks, or days. This topic is now hotter than ever. That's why, in today's easily comprehensible video, you will learn all the basics about this fascinating phenomenon. So, without further ado, my name is Daniel, and welcome to the Greenwave. Inflation is the decline or decrease in the purchasing power of a given currency over time. Simply, purchasing a basket of selected goods gets more and more expensive over time. The rate at which this happens is called inflation. This rise in prices, which is often expressed as a percentage, means that a unit of currency effectively buys less than it did in the past. For instance, let's take the USA and the US dollar. Due to inflation, the price of a regular cup of coffee has increased by a factor of 7.4 since the year 1970. The price for this cup of coffee went from 25 cents to $1.85. Naturally, inflation can be contrasted with deflation, which is the opposite, and it occurs when the purchasing power of money increases and prices decline over time. But this is much less common. Essentially, inflation is sometimes classified into three different types. Firstly, demand pull inflation occurs when an increase in the supply of money and credit stimulates the overall demand for goods and services in an economy to increase more rapidly than the economy's production capacity. This increases demand and leads to price rises. The cause of this is often money printing, which we had an unprecedented amount of in the past 2 years. So in this case, people essentially have more money to spend, and by spending it, the prices increase because the businesses are trying to take advantage of this opportunity. Secondly, cost push inflation is a result of the increase in prices of inputs in the production process. This includes the rising costs for all kinds of intermediate goods. These developments lead to higher costs for the finished product or service and work their way into rising consumer prices. For instance, when the expansion of the money supply creates a speculative boom in oil prices, the cost of energy for all sorts of uses can rise and contribute to rising consumer prices, which is reflected in various measures of inflation, such as gas prices, which is something that we're experiencing right now. Lastly, built-in inflation is related to adaptive expectations, the idea that people expect current inflation rates to continue into the future. As the price of goods and services rises, workers and others come to expect that they will continue to rise in the future at a similar rate and demand more costs or wages to maintain their living standards. Their increased wages result in a higher cost of goods and services, and this wage price spiral continues as one factor induces the other and vice versa. Inflation can be viewed positively or negatively depending on the individual viewpoint and rate of change. Those with tangible assets like property or stock commodities may like to see some inflation, as that raises the value of their assets. However, for some younger members of society, the new generation, it is largely negative because it makes buying a house or a car and even everyday life a lot more financially taxing, aka expensive. Lastly, to comment on the current situation, the goal of the US government and the Fed is to have inflation at 2% annually. However, the current level of inflation is 8.6% and it is continually rising. Hence, simply put, it's a show and we are all. And there you have it, a succinct explanation of inflation. Hopefully, this video cleared it up for you at least a little bit. If you have any further questions, certainly feel free to ask them in the comments below. Additionally, if you liked the video, consider dropping a like, sharing and subscribing for more financial content. We are just getting started here and there is a plethora of exciting stuff coming. So thank you very much for watching and see you next time.